It's fair to say that U.S. is exhibiting a great deal of policy uncertainty, and that's typically true of emerging markets. I do think that developed markets have strong institutions, and that's why they're developed markets versus emerging markets. And I would say that the U.S. still has very strong institutional constraints, which is why you saw a pause in the tariffs very early on in the process. So yes, there's definitely more emerging market-like volatility being exhibited in the US, but I would say that the institutions are still intact, and therefore you will see a diversification away from the US into other assets, but it doesn't necessarily need to lead to systemic risk in the United States.
All right, institutions are still intact, but Sherry and I, for the last 2 days, we were talking about, the assault on the Fed by and from President Trump, all right? And I'm thinking, Trump doesn't necessarily have to fire Powell if he is able simply to give the perception that the Fed is susceptible to political influence or even interference. That would simply be enough, right? And if that were the case, if the market were to take that view, how would that be expressed? Which way would we see, say, U.S. yields go? And what would that mean for your space, for EM debt?
Yeah, absolutely. Martin, it's very interesting because there are several precedents in emerging markets of instances where there's been tension between the executive branch and the central bank. And the reality is that these tensions actually lead to the opposite effect. It's not possible to really talk down interest rates. When there's tension between the central bank and the president or prime minister in whichever country you're talking about, what has actually happened is you end up having higher inflation, higher risk premium, and basically outflows out of the country. So yes, you can have headline risk in the United States, but it's really not possible to accomplish any major adjustment on the interest rate simply by talking about it.
Okay.
Are you entertaining the idea of a recession in the United States? And does that change any of the calls that you made so far?
Well, we cannot rule it out. I mean, certainly there's going to be a slowdown. The market is still divided on whether there will be a recession, what will be the depth of the recession, and what will be the ability of the Fed to react to the recession. So if inflation is well controlled, the Fed actually has ample room to reduce interest rate to be able to manage recession risk. So all of these things are basically out there and to be determined over the rest of the year. It does not change my call on the sectors that I like, because we believe that the credits that we like are going to be resilient to the trade war, to a significant U.S. slowdown, and that default risk will remain low in emerging market and Asia because of the stronger fundamentals, because of the fact that a lot of the defaults have already played out in emerging markets, and many countries are now following much better policies.
Really quickly, you were saying that these are usually multi-year processes. So what really needs to happen in those years and for us to see the trades actually shifting the direction from your experience so far?
I think the one thing that you have seen happen was a very necessary condition, which was the questioning of U.S. exceptionalism. The reality was, in the last 10 plus years, the best place to be was the U.S. equity market, and that is really being seriously questioned going forward. Right now, considering the amount of volatility in the short period of time that we've experienced this, investors are moving to more cash-like instruments. But what we will see over the period of the coming months and years is that they will be looking to geographically diversify their portfolios and diversify them into different sectors and not take a concentrated bet on just the United States.